Well, Intel here reported earnings after hours, and Intel is definitely one of those interesting stocks that I think is a very interesting one. I really like Intel. They're a very good company, so it's one I always take a look at when it comes to earnings. So they dropped 6% after hours. So my question is, what is the reasoning for it? That's after being down 1.7% in the normal trading day too. So overall, the valuation on this company is getting relatively cheap when you look at it. Prior to this after hours drop, a PE ratio of 12.5 actually. So after the drop, even better. So let's take a look at these earnings and see maybe if there was a good reason for it. So from a perspective on these earnings, it's beautiful. This is a beautiful earnings report. Holy crap. Non-GAAP EPS of $1.45, beats by 18 cents, and GAAP EPS of $1.31, beats by 11 cents. That's wonderful. That's fantastic. That makes that PE ratio actually even cheaper for this company. Revenue of 19.83 billion, up 23% year over year, beats by 1.17 billion, and shares are down. That is a beautiful earnings report right there as far as those metrics are concerned. So here's my guess, and I haven't looked at it. Okay, I look at these things live for you. My guess is they actually gave guidance out, and guidance wasn't looking good. It's the only way that can make any sense for that big of a drop. It's the only way. So we open this bad boy. Intel lower after soft EPS outlook. Oh no. Intel reports core 1 beat, driven by data center strength and the Rona-related work-from-home component demand. Data center group revenue was up 43% year over year to $7 billion, which included a 53% increase in cloud service provider revenue. PC-centric business grew 14%, with notebooks posting a 22% year over year unit growth. Cash flow from operations totaled $6.2 billion, with $2.9 billion in free cash flow. Holy crap. Oh my gosh. Intel strengthened its liquidity with $10.3 billion in new debt and its buyback suspension. I don't necessarily like the debt addition. I get it. Sets quarter 2 guidance at about 18.5 million revenue versus a consensus of 18.1 and EPS of $1.10 versus a consensus of $1.17 and 30% operating margin. That's not that bad guidance actually for Q2. That's pretty good. They're not giving a full year guidance because of, obviously, as you expected. But that's not that bad. Down 6% seems massive. I'm about to buy the heck out of this stock. And I'm recording this in the afternoon. This won't post until tomorrow. And if it's down tomorrow morning, I will be buying the heck out of Intel. I'm just going to tell you that right the heck now. I think it's going to be a stock worth picking up plenty. I already have a small position in it, but I'll definitely pick up a larger position if that's the case. Son of a gun, this is a cheap stock. Let's look at their actual earnings report, see what we have to look at. So let's look at this presentation. The virus is top of mind as we prioritize the well-being of our workforce and support for our customers and communities. Outstanding results for sure. Purpose has never been more essential to create world-changing technology that enriches the lives of every person on Earth, and they are guided by cultural values, competitive advantages, and financial strength. We will emerge from this situation even stronger. So they're protecting the employees as the first priority with a 24/7 pandemic team, closely following all social distancing and safety protocols, and vast majority of workers are working from home. They invested more than $100 million to support employees, adding benefits, recognition for employees working on site. Factories continue to operate more than 90% on-time deliveries. Tech collaborations to fight the virus are working with Medtronic and Dyson on ventilators. They teamed with Lenovo and BGI Genomics to accelerate the analysis of genomic characteristics of the virus, and they're providing support relief to channel partners. Good stuff. And for the community, $50 million Intel Pandemic Response Technology Initiative for accelerated healthcare and specific research. They're improving access to online learning and innovation, an innovation fund for employees slash the ecosystem. So $10 million for relief efforts in local communities around the globe, and greater than 1 million PPE for healthcare workers, granting free access to IP for research of the virus and scientists. That's crazy. Their priorities are obviously accelerating growth. Cloud was up over 50% year over year. Comms up 30% year over year. Now 70% of data center segment. Expect base station silicon market leadership in 2021. 1 year pull in on that. Mobileye, the automated car fleet, designed to win major Asian OEM, which is the first ever with this OEM. Sampling Habana's first deep learning training processor to learn CSPs. Exciting stuff. They're improving execution. They fulfilled all committed client CPU orders despite the virus. They launched 10 NM based 5G base station. Wowies, that's crazy. Tiger Lake client CPU coming mid-year, and sample Ice Lake server. They're sampling Ice Lake server. They launched 10th gen Intel Core Comet Lake, first to 5 gigahertz Z Plus in laptops. Crazy. And they're deploying capital. They repurchased 4.2 billion in shares. They're committed to maintaining the dividend. I love that. And they're strengthening liquidity, as you can see, managing free cash flow to disciplined control of OPEX and CAPEX and working capital. Obviously, we see that. From financial highlights, obviously we see quarter one revenue of 19.8 billion, data-centric 10.1 billion on that aspect, and PC-centric brought in 9.8 billion. Exciting stuff. That's just mega good stuff. 63% year-over-year EPS growth. That's just good stuff. So EPS year-over-year, you definitely see a lot of this here. This growth came from a transform to a data-centric company. Look at that, 35 cents they added onto there. Investing in product and process leadership apparently added 14 cents. Expanded TAM added 7 cents. Intensity and focus added 2 cents to that EPS line, and capital allocation decreased 2 cents. Yeah, that's definitely exciting. You like to see it. Sources and use of cash. So cash from operations, they added 6.2 billion in that aspect. Exciting stuff. Total beginning cash was 13.1 billion, and they ended up with 20.8 billion. Holy crap! In total cash investments. Total debt right now of 39.9. We'll look at that for sure. Definitely like to see that. So from platforms, they year-over-year revenue growth was 43%. Adjacencies 35%. Market segments you saw from cloud, they grew 53%. Enterprise, they grew 34%. Comms, they grew 33%. Exciting stuff, just good stuff. Unit volumes for DCG grew 27%, and average selling prices rose. That's right. Freaking 13%. There's growth everywhere. Really good stuff. So in Internet of Things, if you look at that, you see overall year-over-year, you see good growth in terms of both Mobileye and the Internet of Things aspect here. So it's just good stuff to see. Good stuff to see. Shoot. I mean, what can you say? Mobileye grew. That's just good stuff. It makes me excited. It makes me excited looking at this stuff. Client computing group. Obviously, PC volumes were up 13%. Notebook average selling price did decrease 3%, but the desktop average selling price grew 4%. Nothing super significant as far as that's concerned. Nothing really to look at there. Outlook, you see a 12% year-over-year growth is what they're expecting, which is a little bit less than what you saw, 23% from this quarter, but still very good growth. Operating margin down 1 point Not that bad, all things considered. An EPS up 4% year over year to $1.10. Not that bad. I mean, not that bad at all. For headwinds and tailwinds, you see market dynamics. The data center demand is strong in the first half. Second half, expect weaker enterprise and government demand. Strong quarter one notebook demand offsets by expected contraction in the global GDP. The auto, industrial, and retail verticals are down. The impact of market volatility on ACAP and trading assets portfolio remains a watch item. And from actions taken, they raised $10.3 billion in new debt and suspended share buybacks for now. And they have actions to strengthen the liquidity and expected to impact fiscal year EPS by approximately 12 cents. And they're focusing on cash flow management without constraining growth, and they're expecting free cash flow to be resilient through virus impacts as tempered by the first half demand strengths and OPEC savings and capital actions and tight working with capital oversight. Well, that's what I would call exciting. Now, you know what we're going to look at here. That's right. Let's look at what they're expecting here. Look at this free cash flow on this company. $2.9 billion added in this quarter, 3 months ending. $2.9 billion. Whoo-wee. I like seeing that. You really like seeing that. So, I mean, what the heck do you say at this point? They're expecting a little bit weaker of a EPS than we expected, but it's still year-over-year growth. Shoot, this company's trading at a PE that's so cheap, and they're still paying a consistent dividend around over 2% even. This is a company that I'll be adding onto, no doubt. So I hope you're ready for that, because I'm ready for that. I plan on... I might put $200 into the stock. Nothing major, but again, I think if you're looking at Intel stock and anything under $60 is honestly a steal for this company. I don't think that's anything absurd to say. If you're seeing under $60 at this point in the game, come on now. This stock deserves to be trading a little bit higher than it's trading at. It's just, I mean, you've seen good growth, obviously, since this, the dip down in 2009, the financial crisis. You've seen good growth, but not as good a growth as you might expect for a company like this. I think it's a company that deserves another second look. In the past week, they're, down 5% before this 6% downward movement. Year to date, if you look at this stock's down. If you look before the dip, this stock's still down 12% from the dip. And it's a company that really hasn't been affected at all. So I just think this company deserves to be, just take another look at this company, right? Does it deserve to be down 8% since after this pandemic? I don't think it does. So I'm going to be keeping an eye out on this. And I'm probably going to pick up some more if this opens up down 6% still. I'm all in.